As we mentioned last week, I did an enormous number of Social Security seminars during my career as a product wholesaler. Anyone who has done a ton of presentations, of course, has all kinds of war stories. Social Security, we'll talk a little bit later on, of course, is intrinsically linked with politics. And you would think that with how political it is, that there would have been multiple times, if not dozens of times, where there were people in the audience arguing about politics. But in reality, there was always somebody that I called a political wacko, either one direction or the other. In just about every seminar I did, someone would come up with some extreme view and start questioning me. But what was super interesting was, of all the times that I did presentations, I can only think of one time where there were two and they were on opposite sides of the aisle. And essentially they started arguing with each other through questions to me. And so one of them would say, well, don't you think blah, 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 and state their political opinion through that question. And I would, of course, try to answer it from a, factual and centrist standpoint. And then the other person would come back and ask a question that rebutted that question. So eventually I had to use my presentation skills and take both of them offline and say that I would answer more of their questions afterwards, and we moved on. But the very interesting thing to that, Philip, you know what town that happened in?
No, I do not.
Excelsior, Minnesota. Town that Philip lived in for
16 years, 16, 18 years.
Yeah, I was going to say close to 20 years. So Excelsior's kind of on the edge of the suburbs, so it might make a little bit of sense that you've got, people of both political persuasions living in that town. But it just popped into my mind as we were getting ready for this episode. And so with that, we will start episode 18, The Basics of Social Security, Part 2. Welcome to the Valuability Podcast, which is for financial advisors, business owners, and anyone interested in financial planning, business, leadership, and personal development. We believe that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. My name is Danforth Fleek. I was a financial advisor and, as I mentioned, also a product wholesaler for over 20 years in the financial services business. I'm joined each week by my co-host, good friend, and longtime mentor, Philip Simonson. Philip has been in financial services for over 4 decades, also as a financial advisor, a field leader, sales trainer, and a senior manager with positions having responsibilities such as advisor development and field operations. So, Philip, we have our first guest booked for the week after next. So that is super exciting.
Yeah, I'm really excited to for our next upcoming episode. And well done, Dan, getting them booked. And it's going to be on. You want to tell the people what it's going to be on, Dan?
Yes. So it is a longtime friend of mine named David Adler. David has been in the field of education for his career, and so we're going to talk about working with teachers, and then also ways that from an education standpoint we can interface with communities, with all of our communities on financial education. So super interesting topics there. Also wanted to issue a quick apology with last week's episode. It kind of escaped my mind until I was editing it that our listeners in the United Kingdom probably aren't going to be getting all that much value out of our United States Social Security discussions. So hopefully you can listen to our article reviews and get some value out of that. We just popped into my mind. I wanted to apologize about that. And then lastly, we had a question in episode 16 the week before last about unemployment insurance as it regards Social Security. And at the time, I had not found a source to give me a definitive answer. And I have since then found that unemployment insurance does not count towards income for Social Security, either on the benefit side or, as we're going to talk today, as income when you are taking a benefit in terms of benefit reduction, benefit withholding. So unemployment insurance has no impact on Social Security in any way. So just wanted to circle back with that. Wherever you find our podcast, Apple Podcasts, Spotify, Stitcher, or TuneIn, please like, review, subscribe, and share. Once again, if you could reach out, if you're a regular listener, reach out and pass us on to someone this week. That would be very, very, very helpful to us. We have a YouTube channel as well. Search Value-Ability on YouTube, or you can find us on our own website, value-ability.com. Click on the episodes tab. Find us on Twitter and Instagram at value_ability. Twitter is the best way to get in touch with us. We don't have any visuals this week, but any visuals that we reference are always posted on our Instagram account. And then you can also find all of our information on Facebook. Search at valueability, all one word. So, moving on to our main topic, basics of Social Security Part 2. So, last week we kind of covered the intro side of it. How do you get your benefit? How is it calculated? Filing age? What is the impact of filing early versus filing late? This week we are going to start pretty much in the filing process and look at the impact of different things once you have filed. So the first section there is working. Now, you can work and be filed for Social Security if you are before your full retirement age, and this is one of the most misunderstood things about Social Security. There is an earnings limit for earned income. It's probably best to start by explaining what the purpose of this feature of Social Security is. The bottom line purpose of this feature is to make sure that people who are working full-time don't file early. People who file early put a strain on the program. Obviously, they're taking benefits for longer and earlier, and while from a statistical standpoint for that single person, it typically is better for them to wait and defer just from a pure statistical standpoint with life expectancy. The fact that you're taking money out of the program, time value of money, it puts a strain on the program. So they want to disincent people who are still working from filing benefits before their full retirement age. Now, this used to be all the way up to age 70, but now it is just up to full retirement age. I believe it was the second George W. Bush administration changed this. I have that right, Philip?
Correct.
Yep, so changed in the early 2000s from age 70 back to your full retirement age. And the key here, everyone refers to this as a tax or a penalty, and it is neither of those things. It is a withholding. And that is really, really key. So the best way to explain this is to do an example and then explain, because there are some things about it that, especially as an advisor, you would want to know beforehand as you are advising your clients on their Social Security benefits. So the earnings limit for 2020 is $18,240. And the baseline rule is the benefit for every $2 in earned income above that limit, you have $1 in benefits withheld. Okay? So let's just do a little example, and with that, you'll see exactly how this works, how it's implemented, and then most importantly, how you get it back on the back end, because so many people miss out on this. That aspect of it, that you actually get this money back starting when you get to full retirement age. So let's say that you have $1,000 a month as your benefit, and that is your reduced benefit. You're going to file right at age 62. And let's say your full retirement age is age 66. And you are earning $12,000 over the limit. Okay, so that would be right at $30,240 for 2020. So you're $12,000 over the limit. For every $2 over, you lose $1 in benefits, right? So you're going to lose $6,000 a year in benefits. Now, most people would think, okay, I'm getting $12,000 a year. Easy way to do that would be you just cut your checks in half, right? So instead of getting $1,000 a month, you're going to get $500 per month. Well, I used to joke. Of course, the government doesn't make it that easy. It actually, the way that it is implemented, and there actually is a very good reason for this, is they withhold full checks until they have withheld the proper amount of money. So in this example, they're simply going to withhold your first 6 checks. So you will get nothing January through June, and then start getting your full checks from July through the end of the year. So anyone out there that thinks about budgeting immediately will see why this is important to understand. It's a problem if you are depending on that income and thinking that you're going to get $500 a month, and then you file and find out that you're not going to get a benefit for the first 6 months. So very, very important to understand that the way that it happens is they actually withhold your first 6 checks. Now, just to fill you in on the reason behind that, the reason they do it that way is if you die mid-year, it's incredibly difficult for the government to come back and take money from an estate. And it's virtually impossible, bottom line. So in order to do that, to keep that from happening, they withhold the benefits up front. If you do die, say, midway through that 6 months where you're getting benefits withheld, Social Security does pay out the benefits that you should have gotten to your estate. So no, you're not going to lose that income if something does happen to you during that time frame. So did that make sense, Philip, in terms of how the benefits calculate, or how that's calculated, and then how it's withheld? Do you have any questions on that?
And clarification for me.
Yeah.
You and I, of course, I'm 62, be 63 this October. I'm not filing, but let's say I did, and yet I'm a 1099. I do consulting.
Yes.
I do not know that I'm going to be making $12,000 more than what the $18,240, and yet
yes.
They're withholding it. How does that work? If your income is not, shall we say, equal, you're going to get a known definitive amount for the upcoming year.
Yep. Absolutely. Great question. And since I haven't done this presentation in a while, actually, I typically would already have mentioned this. So thank you very much for reminding me on that. 2 things there. Just one thing to clarify. First of all, this is only earned income. So 1099 income from work, or your regular W-2 income. It's not investment income. It's not rental income.
Oh.
It is actual earned income. However, to your point, let's use us as an example, our partnership. You could be taking in income into the partnership and simply not paying it out to yourself because you're self-employed. If you are self-employed, it's a totally different rule. It is if you work more than 40 hours per month, your entire benefit is withheld. So essentially, if you're self-employed, you're just not going to file early because the government knows you have an incredible amount of control over doling money out from your business to yourself. And I can't tell you the number of times that the next question I would get from a self-employed person is, well, how is the government going to know how much I work? And my response was always the same. Well, it's the feds, and they do look, and if they do find out, I have found they do not have a very deep sense of humor. It is Social Security fraud even though in the end, as you'll find out in just a minute, everything does wash out over time. They do take this very seriously. If they believe that you are working around the system and they find out, they will come after you for it. So I just always say, look, it's not worth it. If you're working and you're self-employed, just don't file unless you really are only working super part-time. If you're only working 5 hours per week, or 10 hours per week, go ahead and file, and they essentially take your word for it, and they calculate your benefit based off of the number of hours that you work under the 40. But typically, if you're working, 40 hours per week is your typical work week. You're typically going to be working more than 40 hours per month. So for most self-employed people, you're just going to have all of your benefits withheld, so it doesn't really pay to file early. So
therefore file early and receive a benefit from your previous 40 plus quarters you put in, like we talked about last time, correct, Dan?
So just to be clear, if you filed, if you're still working, they're just going to withhold your benefits. So it really doesn't make any sense to file early if you are self-employed and working any substantial amount. You can still do it. They're just going to withhold your entire benefit. So as that kind of leads into the next section, which is what happens. So essentially what would happen is they would withhold your entire benefit. If you're working over those 40 hours, you'd technically be filed, but they would withhold your entire benefit, and then when you get to your full retirement age, they'd adjust, and it would be exactly as if you filed at your full retirement age. So technically you could do it, but it's 6 to 1, half dozen to the other. It really makes absolutely no difference, because this is how, on the back end, as I mentioned, this is not a penalty. This is not a tax. I hear it referred to that way time and time again by people. It is a withholding process. So going back to our example, let's say that you have those 6 checks withheld when you're age 62. And for argument's sake, the withholding limit changes. It's indexed to inflation each year. But for argument's sake, let's just say you have exactly 6 checks withheld each year, 62, 63, 64, and 65, right? So 4 years, you have had 6 checks withheld for 4 years, or 2 full years of benefit, right?
Right.
So what happens at age 66 when you get to your full retirement age? At full retirement age, you can make $1 million. Your benefit is not impacted in any way. So going forward, there is no more impact. But now they're going to go back and adjust your benefit for those withheld benefits. So what they're going to do is they're going to say, hey, look, we withheld 6 checks for 4 years. That's 2 years worth of benefits. So what we're going to do is we're going to move your benefit to what it would have been had you filed at age 64 instead of age 62. So they actually adjust your benefit up by 2 years. And you then start earning that money back. Now,
versus giving you a lump sum.
Correct.
Of 2 years. Yeah, they're smart.
So next question everybody has is, well, how long does it take me to earn it back? For every month you have withheld, it takes you 3 months to earn it back. So in this example, you've had 2 years withheld. You then have 6 years before you would have earned that money back after your adjustment at full retirement age. So by age 72, you would be, fully flush. But here's the key, and this is the one that bugs me, is because so many people will earn money up to the limit and then they'll stop working. And just think about this. This is the kind of, I always think of the Popeye, I'll pay you, Tuesday for a hamburger today, that whole thing. So you're going to give up $2 worth of earnings today to get $1 in earnings that you'll get 3 years from now or 4 years from now anyway. You're going to give up $2 to get $1. Man, first of all, that makes no sense, right?
Right. And you're going to get it back in cheaper dollars as well because of inflation.
Right. Well, but you can't go back in time and earn that money that you didn't earn in the past once you've gotten to your full retirement age. So it just really makes no sense. And the bottom line of that is it's because people think of it as a penalty and they don't understand that it's withholding. That's the main reason. Now, if you're going to lose it, that kind of makes sense. Okay. Hey, I can not work and make 50% or I could work and make, 100% of whatever figure. That makes sense, but that's not it. It's work and make $2 and get $1 later, or get $1 now. That's a no-brainer. I'm going to work and get my $2 now and get my other $1 later. Absolutely. So that's the reason why I make a big deal out of it to advisors and clients is don't fall into the trap. Work because you want to work, or don't work because you don't want to work. Do not let the Social Security earnings limit dictate whether you're working or not. Work as much as you want to work, make as much money as you want or need to make. It will all wash itself out in the end. So any questions on that before we move on to the next topic?
No, that was good. Very good.
Excellent. So moving on to that withholding, many people think of as taxation. Taxation is totally separate topic. And as I mentioned, with the withholding only being earned income, taxation of Social Security benefits is a completely different calculation, and it's almost exactly the opposite. So your Social Security benefit could be taxed. Either 50% of it or 85% of it could be taxed. And the way that they figure that out is through a calculation called provisional income. Now, this calculation is in every tax guide that you have ever had in your life. If you've ever done your own taxes, you get to a certain line and it says, if you're on Social Security, go to the next line. And if you're not, skip and go to, and everybody skips because you're not on Social Security. There is a calculation in there called provisional income. Every single accountant in the country is also very, very, very familiar with provisional income. It is all income from wages, all income from pensions, all income from investments, any non-reportable income, such as interest on tax-exempt bonds, any other exclusions to income, things that go in there are credits for adoption, those kind of things, plus half of your Social Security benefit. Now, it's easier to tell you the things that don't go in there, and there are only 3 things that I know of that don't go in there. Roth withdrawals, so Roth IRA or 401k withdrawals, life insurance, so payouts from life insurance, or disability insurance payments from an after-tax disability policy. Many times you'll have a pre or a post-tax disability policy, and many people don't. I say, well, why would I ever pay for a disability policy with after-tax dollars? Well, the main reason is the benefit is not taxable, and the benefit also doesn't count towards your Social Security provisional income. So that's really one of the only reasons to use that I know of to use the after-tax option on a disability policy. So that provisional income calculation essentially is all forms of income that you get. If that is $32,000 or less for joint filers or $25,000 or less for single filers, your Social Security benefit is not taxed. From $32,000 to $44,000 for joint, or $25,000 to $34,000 for single filers, up to 50% of your Social Security benefit could become taxable. And then above those numbers, so greater than $44,000 for joint or greater than $34,000 for single, you get into the 85% of your benefit will be taxable. Now, just to be clear, that's not an 85% tax. Some people are like, they're going to take 85% of my benefit. No, 85% of your benefit becomes taxable. So as an example, if let's say your benefit is $1,000 a month and you're in that 50% taxability bracket, $500 per month or $6,000 would get added to your adjusted gross income, and then you would pay taxes on that $6,000. So if you're, in in whatever bracket, you then apply your tax bracket to that amount. So people get really tripped up on that. They think, oh, they're going to take half of my benefit, or they're going to take 85% of my benefit. It just means that amount of your benefit becomes taxable. So any questions on that?
No, that was very clear. And Dan, yes, clarifying.
Mm-hmm.
Now, if I reach my full benefit age, mine is 66 and a half, do I still have to, is that provisional still apply?
Great question. I also typically would, when I was doing this on a more regular basis, would already have mentioned that. The other unfortunate bit is, you mentioned, the withholding stops at the full retirement age. The taxation of Social Security does stop when you die.
That was magnificent. I won't go there. RBs, but yes. So go ahead, make your million.
Right. People throw around the word, and we'll talk a little bit more about this when we get to solvency issue. People throw around the phrase means testing.
Right.
This taxability is already a form of means testing. It's essentially taking back some of your benefit if you make a higher amount of money in retirement. So I also go back to the same theme that we talked about in episode 13 on taxes. Look, I want my clients to be in the 85% bracket. Right? I want you to be living in a retirement where you have, the income to do all the things that you want to do. So unfortunately, that means that you're going to have to be in that 85% taxability bracket for your Social Security. So it's the way that it is. And again, I wouldn't not earn money to avoid
right.
paying a tax. Like, that just always mystifies me, right? So I'd rather have less money just so I can pay less in taxes. As my good friend Greg, who you've met a couple of times, always said, more money is better than less money.
I'm 100% behind him. I've always said if I have to pay more in taxes, it means I'm doing something right.
Exactly.
I have written out, not to impress you, but impress upon you or the listeners, 6 figures to the IRS in some years. So, something's gone right. I'm grateful I'm able to do it. I won't pay more than I need to. I'll make sure, my advisors and you make sure you have a good, very good advisors who can coach you on what you can and can't do in regard to tax write-offs. Take advantage of it. Now, Dan, How about states? Is
Mm-hmm.
there am I correct? And I've heard some states now will tax Social Security. It's just not
Yes,
federal. So that's why some people
correct.
are leaving certain states to go retire in other parts of the country, or where those states do not tax Social Security. Correct?
That is absolutely correct. Yes, that is a state by state basis. So each state chooses to tax Social Security and the method by which they tax it. Some of them use the same qualification levels, some of them use different ones. So, again, this is where having an advisor and a CPA comes in very, very handy, is that you want to look at what your state rules are. Bottom line for me there is, would it be the sole reason that I choose to live somewhere or not? No, but it certainly could be a deciding factor.
Mm-hmm.
Look, getting out of Minnesota winters is going to be 98% of the reason why I leave here, but also might be my Social Security getting taxed, might be that added 2%.
Right, right, and where they've just lived there then just over 6 months and X number of
Correct.
days, so then they can come back here, and then Minnesota won't be the residents anymore, but they'll live a good 5 months out of the year, 5 months and
Correct.
28 days or something like that.
Yep. Absolutely. So moving on then to spousal benefits. This is an area where we also get a ton of questions. And as I mentioned last week, thinking of your primary insurance amount as the focus of your benefit is super, super important. And the main reason for that is when you start talking about spousal benefits, what you start to realize is that everything is calculated off of the primary insurance amount. Many people think of the early retirement age as their quote unquote number, and that you calculate things up from there. The reality is that the primary insurance amount is how your benefit is calculated, and then everything is calculated from there based on spousal benefits. So the base rule is that your spouse is entitled to either 100% of their own benefit or 50% of their living spouse's benefit, whichever is greater. So let's do a quick example. Let's say that we've got, Amy. She was the primary earner. She has a benefit of $1,000 per month. And we've got her husband, Joe. Joe is a stay-at-home dad, and he worked a little bit, but didn't, get all that much in benefit. Let's say that his benefit is $200 per month. And those are both their full retirement allowance. Now, for argument's sake, I'm going to say they're exactly the same age, and so born in the same month, and that then their full retirement age is the same, and let's say it's age 66, just to be consistent. So the first thing to know about spousal benefit is that, so if Joe got to age 62, the first thing you need to understand is that in order for Joe to file on his spousal benefit, Amy would have to be filed. So if they got to age 62 and Joe wanted to file, he could not file his spousal benefit until Amy had filed. You are technically filing on that Social Security number of your partner. And so if that Social Security number is not active, you can't pull your spousal benefit. So let's say that they get there and they decide that they are going to file. So Amy would file. She would get $750, and then Joe could file. Now, his benefit amount, you would look at the primary amount. Amy's is $1,000. Take that in half. Joe's primary insurance amount is $200, but because that's lower, they're going to move his up to $500. Now the calculation is exactly the same. They are now going to reduce his benefit based on the age that he filed. So because he's filing at age 62, they're going to reduce it by 25%. and he's going to drop down then to $375 per month. Now, if he wanted to wait, he could wait all the way up to his full retirement age. So let's say that Amy files at age 62 and Joe decides to wait. He waits all the way up to his full retirement age and files at age 66. He would be entitled to $500 a month, so half of Amy's primary insurance amount, because he waited up to his full retirement age. Spousal benefits do not get delayed credits, so it doesn't make any sense for him to have waited any amount beyond that. So any questions on that? That's the basic. There's one other area that I wanted to touch base, but I just wanted to check and make sure that was clear.
No, that was very clear. Well, as I think about it, though, it was clear certainly on how we did the math. So let's go back to Amy. Amy files, but am I correct in that she can file, but she can say, hey, wait, I do not want to start receiving my benefits on a monthly basis. And so but Joe then, was it Joe? I can't remember. The husband was going to get $200. Can he then, even though she's not getting a monthly benefit, but yet she's filed, can he get his 50%, which would be the $375 because he's filing at 62 and not 66, and he's got to take the 25% haircut.
So the strategy that you're thinking of is called file and suspend, and the answer to your specific question is kind of yes and two no's. Let me explain that. So file and suspend originally was at a full retirement age, the primary spouse could file and then defer benefits and allow their benefit to continue to grow. And then because they were filed, that would then allow the spousal benefit to be drawn. But one of the no's is that in your example, you were asking that, could that be done at age 62? And the answer was no, that could never be done at age 62. It could and still theoretically can be done at full retirement age for people who are grandfathered in. So back in 2015, they did away with file and suspend, but they grandfathered people in. So if you turned age 62 on January 1st of 2016 or earlier, you are grandfathered in and you can still do the file and suspend. So those people are now around 66, 67, somewhere around there. So there are some people out there that could still do that. If you turned 62 on January 2nd of 2016 or later, that is gone. So there is no more file and suspend. So I'll give you an example both ways. So if Amy and Joe were eligible for file and suspend, Amy could file at age 66 and Joe could start drawing his $500 a month at age 66. And then Amy could continue to defer her benefit all the way up to age 70 or whenever she wanted to take it. And so that spousal benefit could be drawn early. But that's at full retirement age, has to be at full retirement age. If file and suspend no longer is an option, Amy would then, if she wanted to delay until age 70, she would just delay until age 70 and Joe would not draw. And then when she filed at age 70, he could file the spousal benefit. But remember that his spousal benefit doesn't get delayed credits. So he would just go back and get the $500 that he would have been due at his full retirement age. So if the primary spouse is going to delay, that does keep the lower earning spouse from filing that spousal benefit until that time. Now that does, however, lead me into my next point, which is you can file early on a spousal benefit and then or I'm sorry, not on a spousal benefit. You can file early on your own benefit and then switch to the spousal benefit later when your spouse does file. So in that example where I was talking about Amy and Joe, Joe could file, start getting his $200 a month benefit. Now that would be reduced by 25%, right? So that would be down at $150. And then whenever Amy files, so let's say Amy files at full retirement age, he would then get the difference between his spousal benefit and his primary insurance amount added to his benefit at that time. So the difference between his primary insurance amount was $200 to $500, right? So there's a $300 difference.
Correct.
So he would keep drawing his $150 and then get $300 added when he files for that spousal benefit once the primary spouse had filed.
And we said that would be age 66.
Correct. Yep. So his benefit would go up to $450 at that point. So you can file on your own benefit at that point, and that allows you then to get some money early. And these are many of the things where, when you start talking about filing early versus filing late, when you start talking about spousal benefits, is really where you get the benefit of having an advisor, because you can really get into the nitty-gritty. And typically, most of the situations that I ran into as an advisor, I usually would have one of the people file early and one of them file later, and it kind of, covers your bets. And so the question then becomes just, what is the correct strategy, or what is the best strategy based on, are the benefit amounts close to each other? Are they, is one earner, have a significantly lower benefit? And you just need to sit down and look at those numbers with an advisor and really map out a strategy. Bottom line for me always comes back to filing versus not filing is, do you need the income? There's no point in putting undue pressure on your investment portfolio if you have a source of income that can relieve that pressure. Now, if you have a portfolio that can survive, you're not putting undue pressure on your portfolio, then that frees you up to have, you're in that situation, Philip.
Correct.
You have the flexibility to say, hey, I can take it sooner, but I don't have to. That's when you really can sit down and look at what the options are for filing with spousal benefits and come up with a strategy on that side. So, but I can't stress enough, working with an advisor that really understands Social Security and the spousal benefits is key. And there are quite a few calculators out there that financial advisors have access to that can help you understand the impacts of those filings. So with that, we will move on to benefits for divorced. So just quickly, if you were married for 10 years or more and you have been divorced for 2 or more years, your former spouse is entitled to benefits exactly as if they were still married to that person. So if that person files for benefits, that ex-spouse is entitled to 50% of that person's primary insurance amount being their primary insurance amount if their earnings are lower. It makes quite a bit of sense to understand why this was put in place. This was essentially put in place for, a stay-at-home spouse not being able to be essentially extorted or blackmailed by their partner saying, well, if you don't do what I want you to, I'm going to divorce you and you're not going to have any Social Security. If you've been married for 10 years or more and you divorce your spouse, they're still going to get a spousal benefit. Now, the key to understand this is that it doesn't have any impact on your benefit. if you are the primary insured, and it doesn't have any impact on if you have a current spouse. So if you have a current spouse and your ex-spouse it files, that doesn't impact your current spouse's benefit. It doesn't impact your benefit. And, a little bit of a feel good about humanity here. Honestly, as I've given these presentations over the years, the biggest reaction I've gotten from this portion is someone in the audience saying, hey, you know what? I need to call my ex-spouse and tell them that. So always kind of warmed my heart to know that there are people out there that would my parents didn't end their relationship on a note where they were ever going to talk to one another again. So it's nice to know that some people did have a positive feeling for their ex-spouses. Now, another interesting note is that when the ex-spouse, or when the primary insured dies, the ex-spouse's benefit does go up to the full amount. That's actually something that I forgot to mention in the previous section. If you're in that situation, so we had Amy and Joe, right? Amy was the primary earner with 1,000 and Joe was at 500. Let's say that they both filed at their full retirement age. So Amy was getting 1,000 and Joe is getting the 500 on the spousal benefit. If Joe passes away, Amy just keeps her benefit. If Amy passes away, Joe keeps the 500 and then gets an additional 500 added on to make the benefit 1,000. The reason I say it that way, many people think of it as Joe gets Amy's check. It actually doesn't happen that way. Joe keeps his benefit and gets the additional benefit added on to that. And that actually, the payments do come in separately like that. And that can be confusing for many people, why there are multiple benefits like that. An example, a cousin of mine was talking about her parents and said, oh no, my dad got his benefit and my mom's full benefit at the same time. I saw it on the bank statements, and that wasn't the case. It was one primary benefit, and then the additional wasn't the full benefit of the other spouse. It was just two payments, and she assumed that other one was the full. So just a small technicality there. But going back to the ex-spouse also gets an increased benefit when the primary insured dies. I would always point out here, you cannot receive Social Security benefits if you're in prison. So do not take that as an opportunity to bump off your ex-spouse to increase your Social Security benefits. And it also is a good side note. You do not receive Social Security benefits while you're in prison. So any questions on the divorced?
No. This one I do not have anything else to add or clarification. Very clear.
Excellent. Well, that wraps up the kind of technical side of things. I just quickly want to touch on the topic of solvency. It always came up. For me, the thing to understand about the Social Security program is that it is inherently political. If you're on the right and you're running in your primary and you start talking about reforming Social Security, someone further right of you starts calling you a big government, sellout, and that you're just like the other side. And if you're on the left and you start talking about reforming Social Security, someone to your left pops up and starts calling you, a naughty so-and-so that's really on the other side who wants to reduce benefits and privatize Social Security. So there is very little political upside to fixing Social Security. And politicians talk about the things that get them reelected. Now, the last time that we fixed Social Security, you'll remember this, Philip. Do you remember when it was? Putting you on the spot.
Well, you will remind me. I know. I know. Young Bush wanted to privatize all of this.
Yes.
And,
No, it was before that.
It was before that. That did not pass. No one was going to touch that. Congress was not going to touch that.
No, it was Ronald Reagan and Tip O'Neill.
Correct.
Back in 1982.
It was the Economic Retirement Tax Act, that whole deal, part of that whole deal.
Yep. Yeah, so many people forget that when Ronald Reagan came into office, one of the things that he did was work with Democrats to make changes to Social Security. And that's when we had some of the full retirement age changes.
Mm-hmm.
And so if you look back at that in 1982, the biggest people who were impacted, as we covered last episode, were people born in 1960 or later. So the people most heavily affected by the change in Social Security were, wait for it, 22 and under. Well, most of those people can't vote. Isn't that a surprise? So, and the people who were the last people that were affected were in their mid-40s.
Well, I will stand correct you there. In 82, 18-year-olds could vote. My first time voting was 1976.
Oh, yes, I did say most of them could
But they don't vote. Young people do not vote, unfortunately.
Yes, but 18 and under can't, and 18 to 22 mostly don't.
Thank you.
So,
that's a fair
yep.
statement.
Yeah, so look, it's inherently political. So from a politician's viewpoint, they say, okay, and where's the payoff for fixing it? Like the next day, people don't start getting bigger checks, or, things don't, change. People don't get a new job, or they don't see their town's economy pick up the next day. So the payoff is delayed. So back to this topic of delayed gratification, Philip, they can't see the upside for them. They definitely see the downside in talking about it. And so it really comes back to us as a populace getting in touch with them and saying, look, this is something that needs to be addressed. I, for a long time, was not particularly worried. We had time. Really small changes make a huge impact to the plan. And so you don't have to make a ton of changes, but the longer we wait, again, the time value of money comes back into the equation. So I am starting to get worried. But the bottom line is, worst case scenario is if we get to the mid 2030s and nothing happens, when the Social Security Trust Fund is exhausted, and we won't get into the political aside of the trust fund got spent. But when the trust fund does get exhausted, Social Security may not borrow. It is not allowed by law to go into debt. The only way they can fix things is by reducing all current and future beneficiaries' amounts by the same amount. Crazily, this is one of the few places I've seen where government made things absolutely equal for everyone. So everyone's benefit would get changed, and right now the projection is that it would be reduced by 25% if no fixes were made. Now, I'm not saying that's good. I'm not even saying that's acceptable, but it's way different than the doomsayers who say, oh, when the trust fund runs out, everything's going to fall apart and we're going to have all these, retirees living on the street. That's a huge problem. Don't get me wrong, but the core of it is fixable. If this is something that you're concerned about, get in touch with the people that represent you and tell them about it, because it needs to be fixed from a political standpoint. So that wraps up our main section. Any last comments before we move on to the article, Philip?
If you can, I know we're running up against our hour, but Dan, can you 60 seconds or less, touch on disability and some helpful hints if we have any listeners out there who might want to file for disability. What
Sure.
is the best techniques?
I will try to keep it 60 seconds or less. But so my mother filed for disability, and amazingly, she is one of the very rare people that applied and was accepted with her first application. The first thing to know about Social Security disability is finding a doctor to do it with you is likely going to be your hardest part. Many doctors just don't want to get involved because it is a very time-intensive process, and bottom line is they don't get paid for it. And so we ended up having to find a general practitioner who had strong emotional ties to my mom, had been her GP for several decades. So first thing is you need to find a doctor that's willing to go through the process with you. Second is you're probably going to get denied the first time. Understand that. Then you go through the review process and appeal and go through that there. It is very stringent. I know Social Security disability gets thrown out there by people who are wanting to use it as a example of government excess. Losing 2 limbs doesn't automatically qualify you for Social Security disability. Losing 3 limbs automatically qualifies you. That I always use that as an example. It is not easy to get Social Security disability. Mm-hmm. And honestly, the things that you have to endure in order to qualify, you just would not want to endure. And so this idea that it's a bunch of people freeloading off the system, in my experience, just not the case. There are also services out there that can help you with your Social Security disability claims and appeals. Similar to the debt reduction, I would be very, very studious in getting referral checks. That is an area where been known that there are less than reputable people trying to take advantage of Social Security disability people. And I will just make one note again. We mentioned it last time, but Social Security disability qualification is very different than retirement. It's 3 out of the last 5 years. You have to have worked 3 out of the last 5 years. So if you become disabled and you're doing other like workers' comp claims, make sure you file that Social Security disability claim before 2 years from the last time you worked, or you will become uncovered. Again, even if you're going through another process, get that claim in. You can always withdraw it, and as I mentioned before, you're likely going to get bounced the first time anyway. So, but those are the general topics there. So, moving on to our article for this week, rather a somber article. I'm sure if you're involved in the financial services industry, you have seen this topic by now. Robinhood customer commits suicide after seeing $730,000 negative balance. So the essential story is a university student was doing an options trading strategy, basically where you have 2 options offsetting each other, and the core of the issue came in is that one side of the trade essentially settled and showed, and it ended up showing a negative cash balance of $730,165 when the account had only $16,000 in it. And the poor person saw that and ended up taking his own life, stood in front of a train and committed suicide because of this, left a note and said that was why. The horrible, horrible reality was that it was simply because the other side of the option strategy had not settled, and had this person waited until Monday, they would have seen that the other side would have settled, and it would have offset that. And I picked this for a number of reasons. The first and foremost is not making light of the fact that somebody lost their life here, but the world constantly is creating this, blurred line between reality and fiction, whether it's my PlayStation games that, when my mom was alive, she would come out and have to do a double take as to whether the sports game I was playing was actually real, an actual game, or whether it was a video game. And sometimes she would come out and look at a real game and go, "Oh, you're playing video games." Like, "No, Mom, this one's real." But this is extending into just about every area of our life, and it creates this, area where people can get involved in serious matters with serious amounts of money, thinking that it's essentially a game, and with tragic consequences. And for me, the bottom line is that this was somebody who was getting involved in investment strategies that were beyond their means. And I am a person that is absolutely behind people being free to do the things that they want to do, but with that comes a responsibility to know your own limitations, and that to me is kind of the backstory of all of this, is that it is just such a shame that somebody went beyond what they should have been involved in and didn't have the self-realization to just take that extra day to figure out what was going on, and with tragic consequences. So, Philip, your thoughts?
Yeah, I think you covered it, Dan. I'm in total agreement. Total agreement. Very somber. It's too bad. I know there's three sides to every story. There's his, and the truth. Hers, and hers, and there's probably more to it than what we're seeing. So ultimately, I would just say, look, don't invest in something you don't understand or don't have a proven, you don't have the ability. And don't, is the first thing from this lesson. Second thing from this lesson to those who are out there on Robinhood, I always played with the rule, look, this is like gambling. The quickest $10,000 I lost was, in oil and gas, doing the drilling down in Texas when I lived in Texas. Put 10,000 in with, I'll just say, my good friend and partner, and the head of sales for a large Fortune 100 company. And 24 hours later, we were out 20 grand. It happens, but it should be 10%. 10% of what that you have as investable assets, you are willing to take a risk on these high flyers. And the other thing is, after reading that article, Dan, and thank you for sharing it, is that look, they try to, the Robinhood's trying to, in my opinion, and the comment that caught me was the gamify. Well, that's no different than making it like a casino, and those casinos know what they're doing. You don't see them going belly up. They go to that high emotional state of the brain where they're, exuberance, happy feelings, excitement,
serotonin.
It releases the dopamine, and that's a blocker from being able to access the prefrontal cortex of your brain, where logic, reason, and planning exist. So, stay away from that stuff. That's too scary stuff. Anything like that, no, stay away.
Yeah, there's a place in the world for day trading, but don't confuse that with investing.
Correct.
And, as we mentioned in our meeting before we started recording, we had a client that came in and wanted to be involved in commodities. And, I was still new to the business, and I think you probably shared that oil and gas story with that client and said, look, you're getting into a game with, people that do that for a living, and you're essentially just gonna give your money away. And we tried to steer him clear. He ended up going somewhere else and lost the $10,000 that he had invested in commodities. And it's not an exact. I mean, like an option strategy like this is supposed to have a limited downside, right? That's the real tragedy of it, is that he knew enough to be dangerous, right? He was doing something he thought was safe, but that just points back to just really didn't understand the structure of what he was doing. And so, yeah, a horrible, horrible, horrible set of circumstances. Wanted to wrap this section up by sharing some suicide prevention phone numbers. In the United States, the National Suicide Prevention Line is 1-800-273-8255. Again, 1-800-273-8255. And in the United Kingdom, it is 0-8457-909090. Again, that's 0-8457-909090. And one of my clients, just to wrap up, in my last wholesaling job was a suicide survivor. And he talked to me every single time I was in. He would remind me, hey, if you think somebody has something going on, say something. And he was always adamant about that. Say something. You can never go back if you're wrong. And if you're right, even if it costs you the friendship, you need to say something. So I just thought his words popped into my mind there. So wrapping up the article section, we will move on to our close. If you have topics that you would like us to cover or questions, reach out to us on our Twitter account at @value_ability. That is the best way to get in touch with us. Or you can find us on our website, value-ability.com. Click on the Contact Us tab, and there's a form there that you can send in topics and questions. Or you can find us on Facebook at ValueAbility, all one word. Wherever you find us, please, the continual mantra of podcasters throughout the known universe: like, review, subscribe, and share. Next episode. Episode 19, it's a meeting, not a circus. How to run effective meetings. Philip, I'm very much looking forward to that, and thank you so much. I know we went a little bit long this week, but thank you everyone for sticking with us. And Philip, thanks for the great conversation.
My pleasure, Dan. Great job. You've got mastery on that subject.
Excellent. And one last thing, share with us your funniest bad meeting story. Everybody has a story about a terrible or bad meeting that did turn into a circus. So reach out to us and share on one of our platforms and share that with us. As always, thank you for listening. Join us next week. And remember that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. This is a podcast collaboration, not a peer-reviewed journal or a sponsored publication. We make no representations as to accuracy, completeness, correctness, suitability, or validity of any information in this podcast and will not be liable for any errors, omissions, or delays in this information or any losses, injuries, or damages arising from its display or use. All information is provided on an as-is basis. It is the listener's responsibility to verify their own facts. You should be aware of the real risk of loss in following any strategy or investment discussed on this podcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this podcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this podcast. Before acting on information on this podcast, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor. The views and opinions expressed on this podcast are those of the authors and do not necessarily reflect the official policy or position of any other agency, organization, employer, or company. Assumptions are not reflective of the position of any entity other than the authors, and since we are critically thinking human beings, these views are always subject to change, revision, and rethinking at any time. Please do not hold us to them in perpetuity.